Every home has a story. Every loan has a strategy. And every buyer deserves the truth. Welcome to the House Rules Podcast.
What's going on, everybody? Welcome back to House Rules. I'm John Binkowski, realtor at Century 21 Signature in Flushing, Michigan, alongside Carter Bastien, loan officer. Talk to him, Carter. Let him know what's going on, man. How you doing?
I'm doing pretty good. Just helping people be able to qualify and afford homes. Isn't that what we're talking about here today?
Absolutely. Yes, it is. That's the name of the game. Tonight, we're talking about affordability. What do I qualify for if I'm a home buyer? How much can I push my limit? Affordability being a moving target. Interest rates are always changing. The market's always changing. The economy's changing all the time. How can home buyers navigate a very rough sea when it comes to navigating the market? Sometimes a first-time home buyer, sometimes they've owned several homes, but no matter what, nobody's navigated a real estate market quite like this one that we're in right now. So let me ask you this, because I love deferring things to the lender, to the loan officer, whoever it may be, when people have lending questions, when they're talking about money, dollars and cents. What's my monthly payment going to be? What do I qualify for? X's and O's. That's the loan officer. How can you keep the payment low for people that are concerned about their monthly payment, especially if they're pushing their maximum, they're pushing their limit? How do you structure a loan to allow the home buyer to keep that monthly payment in check?
Yeah, well, that's one of the things that's the beauty of being a mortgage broker is I'm not tied to one lender that I'm working with. What I'm able to do is work with our wholesale lending partners that we're currently partnered up with, about 35 of them. They each have different options that might have creative products or solutions for what a particular person might need. For example, some non-QM financing, which I'll spare you the details on all the different types of non-QM loans, but they also have different pricing. Every lender does. It could influence the decision with how we choose the lender. There's a lot of different creative financing options in summary.
So it's helpful for me to know a little bit, to be able to get some background information to then tee them off with the loan officer, so that the loan officer has a good idea of where they're at before they pull all their information, before they pull their credit, before they get their pay stubs and figure out their income situation. So what I try to do is I try to ask them, hey, what's your credit look like? What's your credit score? Because my goal is I want to make sure they have good credit. I want to make sure they have stable income. That's two things first and foremost. Then usually I'll ask them, what kind of payments do you have on a month-to-month basis? Do you have a rent payment? Do you have a car payment? Do you have any credit card debt? Things like that. So I'll kind of do some poking around and see what their situation is. Everyone's situation is different. There's no two home buyers that are the same. So getting an idea of what they think they can qualify for before they even know is a good thing. And then once it gets down to brass tacks, that's when I usually pitch them to you. Hey, this is what their credit score is. They got income, they got employment. So that kind of gives you as a loan officer some background information. You'll be able to get a better idea of what they can qualify for before you even pull anything. So that's what I try to do. I try to pull some information, do some poking around, ask a few simple questions, and get an idea of where they're at financially before we can really get them a raw number, which is the end goal. And that's what I like to get from any home buyer before we even look at a house. Because if we're looking at homes blindly, we might not know if they're in our price range or not. To get an idea for that early on, to then eventually get that pre-approval letter before we even start looking, before I put them on an emailer, before I put them on any searches, anything. I want to make sure that we have that pre-approval letter in hand and that's current, so that no matter what, if we find the house of our dreams, we're able to put an offer in on that property if it fits all of our criteria. We're not waiting around, not finding the home of our dreams, then having to get pre-approved, because then we're behind the eight ball. In this market, you can't afford that kind of time. Every minute, every moment is important. So we want to be able to.
And I've always wondered, like, it seems like, at the point that you connect me with a buyer, or you or any referral partner for that matter, the buyer always seems to have some number in their head that they've decided they want their loan amount to be and what they think they're able to qualify up to. And I wondered where that number came from, if it was something that they had in their head that was a preconceived notion from their own research they've done or their previous experiences when rates could have been completely different. But I always did wonder where that number came from and how much of that conversation was coming up with you as a realtor prior to the handoff.
I'm interested too to find out where they get that number because, and we talked about it in the green room, people that are buying homes, a lot of times that if they never bought a home before, they don't know where to start. And we have to be able to spoon feed them with information that's going to help them get to the point where they can find out this is how much of a home I can afford, especially in this market. Back in the day, or even back during COVID, you had a lot more buying power than you do now. You're talking interest rates in the twos. That's unheard of now. I don't think we'll ever see that again in our lifetimes. Figuring that out, having the buying power that you had back in early 2020 compared to what you have now, it's still lower than it was. It's still actually better than it was in the 90s, lower being the interest rates being lower. I mean, you had interest rates in the 15, 17% range back then. But the thing is, the difference then is house prices were so much lower. So the interest rate really didn't matter as much.
Yeah.
So now you have a medium, I'd say a low interest rate historically, but really it's a higher interest rate in the recent history books, looking at it that way. But
you did make a great point. Like, it is relative based on what are they comparing that to when they were searching for a home or when they bought their last home when rates were at 2%, because what they can qualify up to for their home was a lot different then than what it would be now. So as far as even 7.5% versus 5.5%, I wrote down this example of a $300,000 loan where you're looking at a $2,000 a month roughly payment for your principal and interest, but between a 7.5% and a 5.5% interest rate, that's a $400 a month difference in those two rates. And that's only a 2% swing. If you're going down to 2%, think about the difference in that versus a 7% interest rate or 6.5%, roughly where it's at now, a little bit lower. But, a 5% swing in the interest rate on your payment, the amount of home you can qualify for is going to be a whole lot different.
Exactly. And your what you can qualify for month over month is really equivalent to your buying power when it comes to the number at the end of the day, the sale price. So considering all that stuff, especially if you bought a home in 2020, you didn't have any kids, but now you got some kids on the way. It's 2025, late 2025 out. You want to be able to upsize. That's the conversation. That's what you might be comparing.
Is very helpful for me to have of course it'll come up in conversation, but maybe you've identified by talking to the client that they do have these life circumstances coming up. These are what their goals are. It helps me structure their loan to know where they're at in their life and useful information based on conversations you may have had and found out that they do have some upcoming expenses. Maybe they're getting married next year and they could use little bit of relief on their mortgage payment temporarily as they're saving up for some big expense that they have coming up. And finding out from you, it helps me give them the best options to align with whatever their goals are so that they're going to have a payment that they're comfortable with and that they can qualify for, while maximizing the purchase power they have while they're shopping for their home.
Absolutely. All these things have to make sense for them to be able to get into a home, which is both of our goals and their goal too. At the end of the day, ultimately, we're the navigators that are navigating the rough seas, which we're dealing with in this market, in this day and age. Nobody, since the Declaration of Independence was signed, we haven't seen the market that we're in right now.
Yeah,
for home buyers. So these are unforeseen times. We're in uncharted territory right now, really.
It's a moving target as far as affordability that they're trying to aim at when they're saying, okay, I can qualify. I want to buy a $300,000 home. I'm good to be able to do that. It checked out with the lender. It could be a completely different situation the next year. Not everybody's going to realize the changing landscape and the changing dynamics of different variables, not just the market moving and affecting your principal and interest payment, but when they're shopping for homes, property taxes are going to be different everywhere. So that's going to play into their overall bottom line monthly expense of what the lender is going to be able to qualify them for, what's going to exceed the threshold for their debt to income ratio and what's not.
Absolutely. I guess that brings me to my next question of when you have a limit, let's just say your limit is 275. For the sake of simplicity, let's make it 300. How close do you want to get those people? Obviously, as a lender, and you can defer and use other lenders. So it's not just you saying, okay, this is what you qualify for, period, end of story. But when their maximum is 300,000 and they say, how close, and they ask you, how close can I get to that limit? Because I want to save some money for incidentals, rainy day fund. Maybe the hot water heater goes out and I don't have a home warranty. I want to be able to save some funds. I want to put some funds aside for that, for the furnace goes out, whatever it is. You can't prepare for everything, but if something goes wrong and it's not covered by your homeowner's insurance, I want to save some money. So if they say, I don't want to push my maximum, I guess what is that maximum there for? And can that home buyer push that maximum to the exact penny if they have to?
Yes. And I think that they have to in a lot of instances because it's already set up for the lender to qualify them with a conservative ratio to make sure that they're going to have sufficient amounts of their qualifying income, over 50% in most cases, left over to put aside or put towards other things after all of their expenses are being accounted for. FHA allows you to go a little bit higher for the debt to income ratio threshold than a conventional loan, for example. But in some cases, like they're not fine lines of where this is where the cutoff is. Like there is typically around 36% on the front end, over 42% on the back end is like the standard ratios with conventional loans. But the strength of their credit profile in other aspects is going to play into it. Ultimately, it's going to be determined by the automated underwriting system, or AUS, which runs it through the investor's guidelines and sees if, when taking into account everything on their credit profile, including their duration of different credit accounts that they have, if they have additional assets and reserves to tap into, how much money they're putting down for their down payment. When it takes everything into account, it'll tell you right then, approved eligible or ineligible. And if it's ineligible, you've got to structure it so that it becomes eligible again if you're hovering around those lines. I'd say if the client feels comfortable with making that payment structured up to the limit of the lender allows, then yes, it happens very often that people are pushing those limits. And I'd say go for it.
So I guess what you're saying from what I'm understanding from what you're saying, that incidental, that rainy day fund is somewhat accounted for in that number of 300, correct?
On paper, the expenses being accounted for are what's showing on their credit report. Like, people aren't putting their phone bills or other subscriptions that they have and things. So it's not being taken into account. The rainy day fund, that's going to be more based on like the client's preferences, how much of it they want to put aside and and especially in a lot of cases, like people that have a lot more experience than me with financial planning and managing their budgets. And it's kind of stepping outside of my lane a little bit if I try to tell them too much of how much money they should put aside. But I can tell them exactly what they need to do to be able to qualify and what the lender will allow and give them a realistic snapshot of what their payment will look like. And from there, the rainy day fund, that's personal discretion. I think that that's based circumstantially on how much the client feels comfortable with and having left over outside of the lender's qualifications are one thing, and then it's something completely different of how much the client feels comfortable with as far as what they want to put as a portion of their overall income towards their mortgage payment or their housing expense.
Gotcha. So what's being calculated as far as the home price, that is your goal, is what do you qualify for buying power to buy this house and continue to make payments on it based on your current credit, based on your current income with your employment, and then your own budgeting as far as saving for a new roof or saving for a new hot water heater. That's kind of expected from the home buyer to, if they qualify for X amount, that they have these budgeting skills already.
Yeah. And you and I mean, we've seen a lot of different situations. So I think we probably give people our opinion on things when ultimately, they have decisions to make as far as what they want to leave left over. We can make them aware of these things that may come up and these expenses they might not be accounting for as a homeowner, because it comes with a whole world of new things. You're probably going to have things around the house you're going to want to do once you're a homeowner. It becomes a lot different. If the utilities, the washer or dryer breaks down, you're not going to have your landlord to be able to pay for that. You want to have money set aside, and we can prepare them for these expenses, but we can't really tell them this is how much you should set aside for that, because ultimately that's going to be up to them. So I think we can prepare them by giving them an accurate estimate of what expenses they're going to have as a homeowner, but we can't really tell them exactly how much beyond that, beyond the lender's qualifications, how much they should put aside.
Gotcha. That makes sense. And I think it's expected, if you're going to be buying a home, that you should be budgeting correctly according to your income, or you and your spouse's income, or whatever your situation may be. Take all those things into account, put it in a blender and be like, this is what I can afford. And I also should be budgeting at the same time to be able to save and be able to afford things if they go wrong. Appliances, hot water heater, furnace is the two that come to mind the most that are going to affect your living situation as it is. You want to be able to shower with hot water, wash dishes, cook with hot water, and you got to be able to keep your house warm, especially in Michigan. If your furnace goes out and you don't have a wood burning stove or any other way to heat your home, somewhat of a life or death situation if you can't heat your home with a furnace.
Oh, in these Michigan winters, it sure is.
Yeah, they're no joke.
Yeah.
I guess in that same vein, what are some other creative home affordability hacks that aspiring home buyers, first or second or consecutive home buyers, what can they do in this market to navigate this market and be able to find the home of their dreams? How can they be creative in this market to save some money, make owning a home more affordable? Because what they say now, and I've heard this from multiple sources, is that the median home buying age is 40 years old.
Sheesh.
Okay. And we want to bring that down a little bit and make it possible for people our age, 29, 30 years old, to be able to afford a home and get into a home, especially if they're growing their families. Time waits for no man. So we want to be able to get home buyers into homes when they want to and not have to wait till they're 40 years old. What are some things that these home buyers can do to hack the market?
Well, starting with how you structure the loan. I mean, the two biggest things that are going into the pricing of the rate that they're getting. I mean, you've got your base price from the lender, and then you've got adjustments going into it, which are influenced by the amount of money that they're putting down, as well as their credit score. What some people say they want to put 10% down, and they reach this number in their mind that's just what they want to do, and they think it's the right way to do it. But they may not realize that actually the way that the adjustments are set up, they actually reward putting less money down. You're going to get less of a pricing adjustment for putting 5% down than you would for putting 10%, which is counterintuitive. By helping people understand the adjustments and where they're coming from, it helps them figure out of what they actually should be putting down. A 20% down payment, you're going to be able to not have mortgage insurance required. So if they could put 20% down, then that could reduce a significant burden that's being lightened from their payment by removing the mortgage insurance if it's something they can do. The other thing on that is temporary rate buy downs is huge. You can get a temporary rate buy down with your seller concessions for a fraction of what it would cost to permanently buy down the rate. And most people right now, when they're buying a home, they're getting a high interest rate, or relatively speaking, a higher interest rate, with the idea that there's going to be an opportunity in the next few years where they can refinance. So if you have a temporary rate buy down, it's a lot less expensive than permanently buying down the rate. And if you're permanently buying down the rate and refinancing in a couple of years, then you're paying for 30 years of amortization to buy down the rate, finding an opportunity, the first one that comes up, to be able to refinance into a permanently lower rate, if that makes sense. I don't think I explained it very well.
And I got to be honest with you, Carter, being the realtor, hearing you, we'll just say you're spitting bars, okay, with lender lingo.
Yep.
It's almost a little bit too much for me to take in, especially when you're talking about different types of loans and stuff. So I guess with that being said, and that's why I love, if someone has a lender question, kindly ask the lender. I don't want to give you bad information. This is more in-depth, advanced stuff when it comes to the lending process. So I guess, how do you dumb that down to be able to put that in layman's terms? Because I would need it dumbed down. By all means, a home buyer, especially a first-time home buyer, would need that in layman's terms. How do you go about doing that?
Well, I wouldn't be explaining it in hypotheticals like I am right now. And it's not something I typically bring up to people of, if we get seller concessions, we can temporarily buy down your rate. It's something that, as it comes up, when we're going through their different options, then I'll show them what it would look like without a temporary rate buy down. Maybe I reviewed the purchase agreement if somebody is already under contract and we're finalizing their loan terms, trying to get them locked in so that pricing is going to stay consistent. Because that's the other thing that contributes to the moving target, is the market changes every day. So when we're working on locking in their rate and we're structuring it, I'll show them one of the options without the temporary rate buy down. And then I'll also show them, well, hey, we could use $7,000 from the seller concessions to get you a 2% lower interest rate for the first year. So that would be with a 2-1 buy down, 2% the first year, 1% the second, back to the note. But it's kind of something that, I'm not trying to overwhelm them with too much information up front. So I don't say, hey, look out for the temporary rate buy down opportunities, or this is what you could get if you buy down the rates. It's a balancing act of trying to get them the information they need and giving them the best options, but not overwhelming them with too much information.
That's the key right there. And I think that's even translatable to the home buying process. You know what I mean? So once they get that pre-approval letter back, navigating that and then curating a search based on their non-negotiables, things that they'd like to have, things that they don't need to have per se, but they wouldn't mind having 2 or more bathrooms, 3 or more bedrooms. We'd like to have a basement, but we don't absolutely have to have a basement. We'd like to have a fireplace, don't absolutely need a fireplace. So navigating that by curating their search is something that I do. But
and I'd
also,
say too,
go ahead.
Based on, when they're still in the home searching process, it's important to remember if it's somebody that's pushing the limits, that at that point, a lot of those figures are nothing more than estimates, the most accurate estimates we can come up with at the time. But there's going to be figures that are going to adjust, like the rate, for example, that could change from day to day. The homeowner's insurance, most people are not going to have their homeowner's insurance. Well, they couldn't have their homeowner's insurance policy finalized before they find the property even. Each property is going to have different amounts for their property taxes. So these are all things that are going to vary. And if we're basing their bottom line overall monthly expenses based off of these estimates and we're pushing the limits for their DTI threshold, then it's going to require the loan to be restructured in a lot of instances to be something that does stay below those thresholds. You can lock the interest rate anytime that we have the property address. We get them under contract at that point, like with purchases, especially in this market where things can get a lot worse. If they're comfortable with the payment, we've reviewed the terms and identify, okay, this is a good time to lock your interest rate, then in most cases, we don't want to float it for too long. We want to get that rate locked in as soon as possible. After getting it submitted into underwriting, the appraisal could come back different than what we expect, which is going to make a need to restructure the loan again. The homeowner's insurance policy that they get, there's a lot of different things that happen at different points throughout the loan. I'd just say as the loan progresses, there's going to be figures that are getting finalized that were nothing but estimates before, and the closest to the exact figures we could get, but the actual numbers weren't available. So different things happen in different times throughout the loan process, but everything's going to develop as we get closer to the closing table. And luckily, me and my team moved very fast. We're able to get you those numbers so that there's not any last minute surprises.
Absolutely. And that brings me to my last thing that I was going to ask you about. Obviously, being truthful and transparent throughout the entire process is something that we have to do. It's dependent on our livelihood as realtors and as loan officers. So what do you do to maintain that transparency throughout the entire process, especially if things are changing? How do you maintain that transparency? How do you communicate that transparency to any home buyer?
Clear communication, open and honest information up front. Basically having the conversation that we just did, letting them know that the exact things that are subject to change and that are estimates. When we're reviewing their loan estimate, I'll tell them, hey, this is your homeowner's insurance monthly payment based on an estimated annual premium of this amount. If you find homeowner's insurance that ends up being less expensive, that number is going to go down. If you find homeowner's insurance that's more expensive, that number is going to go up. We've probably at that point had some sort of conversation, especially for people that are close on the DTI thresholds, of the importance of keeping those numbers as close to what the estimates are as possible with anything that's within your control. Of course, there's some things, the appraised value that you can't control, but everything that you can that's within your control. I mean, you don't want to go out there and find the policy that offers the most coverage possible if it's somebody who is working with a tight budget and who is trying to minimize their monthly expenses to be able to qualify.
A clear, concise communication is key for both the realtor and the loan officer. And that's how you keep your clients happy. That's how you get referrals. That's how you keep everything out in the open. You don't want to have anybody in the dark about anything. You don't want it to be because of a lack of information or a lack of communication of that information that causes you not to get a referral or causes you not to have a repeat client. All those things are very important.
And one thing that I do want to bring up, like in particular, that I think is important is the difference between qualifying income and actual income, or the difference between what a client tells me I make this amount per month versus what the lender is using to qualify them. And it's going to depend on their type of income. Is it W-2 or are they a 1099 independent contractor? Like, are they all types of different scenarios that people have depending on their income type? If it's variable income or if they're just a W-2 hourly wage earner, where they're getting a consistent amount, 40 hours a week, have been doing it for years. They also go off of their net income too, versus the gross amount that's after taxes. So that's one thing that people need to take into account is the qualifying income versus what they're actually making, and knowing that it's a different number. So they don't need to know exactly like, this is how they're going to qualify my variable income. Sometimes people will get angry where they're like, I make way more money than what they're able to use. So I will have to explain to them a little bit at that point.
Qualifying income will never be less than their actual income.
So the type of income, though, because I wouldn't say never say never. Justin Bieber, wise words.
I guess.
All types of different situations. It's not going to be the same. I don't want to say it's never going to be less, never going to be more, but it's not going to be the same. And maybe they're only using one source of income. If it's a husband and wife situation where they're only qualifying with the husband's income to be able to stay below a threshold for area median income limits for a down payment assistance program. That's just one example. But there may be programs that are based on their income, so they're not using all of their income to qualify. And I could go on talking about all the different considerations when you're trying to calculate the income, but I don't think anybody wants to hear that. So essentially, I guess what's important to know is that your qualifying income is going to be different than what your actual income is. So it's something to take into account too for consideration when people are considering what they feel comfortable with for their monthly payment.
Yeah, I think that's good. That'd be good for another show because that's an important aspect of the home buying process, especially with married couples.
Yeah.
That a lot of people don't know. And it's information that is important to know, maybe even before you get pre-approved, to be able to put all your eggs in one basket, but only use half the eggs in the basket to get approved for a loan. So
I'm going to review their application. They're going to include all their income in their application, but when we're submitting it to the lender, maybe we will have already had a discussion, myself and the client at that point, where I let them know, hey, we're going to benefit by only using your income to qualify. That could make us a little bit tighter on the DTI ratios. A lot of it's on me to identify those opportunities, me or whatever lender you're working with, to identify those opportunities of creative ways to structure the loan and ways that you can qualify them based on what their income is, and give them the proper recommendations so that they can decide for themselves how they want to do it.
Perfect. I love that.
Boom. Well, I think we gave people a lot of good things to think about and how much home they can afford, but there's always going to be questions. Both you and I know are here to answer them for anybody who has them. So they don't have to do it on their own. And that's something that's going to be important for them to remember. Anybody who's considering how much home should I be, or what price range should I be looking at when I'm shopping for a home? They don't have to figure that out on their own. And you can feel free to hand them off to me at any time because I'm happy to answer any questions they have. When it comes up on a case-by-case basis, I can pretty easily look at somebody's circumstances and situation and give them the best recommendations based on that.
Right. And I think that's one of the most fun parts of our jobs is we don't know what's going to be coming on the docket in a week, in a month, in 6 months. So it's an ever-changing experience for us, and we have to be versatile. We have to be up to date
mortgage
with things. So it's important. It's important to be in the know with this stuff. And absolutely, they don't have to do this alone. They have us to navigate the high seas of home buying and to help them and assist them as much as possible. And we're here at every turn to be able to answer those questions.
Did you say what was coming up as far as like a portable 50-year mortgage is what you're talking about?
Oh, man, I mean, that might be in the cards, but that might be for another show. We talk about that.
Yeah, that would be a good one.
But it's a very complex, and this is the last thing I'm going to say, it's a very complex topic where there's a lot of subtopics in between the lines with home affordability and how much can I qualify for and how much can I push my maximum and different types of lending and loans and things like that. So look for a lot more on this topic, on this macro topic, at more of a micro scale maybe in the future. So we're not done talking about this. This is something that is very much a core part of our business.
Oh yeah, baby. We're here to help however we can. But I think now we scrape the surface on some of the considerations with when you're considering how much home can I afford. But there's definitely more to come. So people are going to have to tune in next time if they want to see that on the next episode. one of the next episodes.
That's right. That's right. Thank you guys so much for tuning in to House Rules. We're happy to have you guys with us. We'll see you here on the next episode.